And welcome. It's the weekly economic update for June 21st, 2021. Hope everyone had a good weekend. It was Father's Day yesterday, so hope everyone enjoyed their barbecues and sitting around being lazy like I did. Watched some baseball. The Astros swept the nasty White Sox. Yay! So a little revenge for the 2005 World Series. So I think they're off today, so I'll be quite bored watching the other baseball games around the nation. So anyways, like I said, hope everyone had a good weekend. And as far as the weather report here in Colorado, it's a little overcast. It was in the 40s this morning when I woke up, and a little chilly in the house because I left a few of the windows open in the kitchen. So I actually have the heat on right now. So as hard as that might be to believe for folks who are sweating their asses off down in Texas, yeah, my heat's on. So anyways, all right, let's go ahead and dive into the financial news. Let's start out with the weekly economic update. The week on Wall Street, the messaging from the Federal Reserve caused a lot of gyration in the markets last week. The Dow Jones dropped 3.45. S&P lost 1.91, NASDAQ was down 0.28, and international was down 0.64. So looks like the Dow did the worst. Your Standard & Poor's stocks, those 500 were a little better. NASDAQ barely down, and international certainly not too bad. So as far as unsettled markets, this right here, the Federal Reserve announcement on Wednesday that interest rate hikes may likely occur sooner than expected, and that it underestimated the pace of inflation, unsettled investors. Really? You've underestimated inflation? Shocking. Well, I'm not surprised. I mean, it doesn't take a genius to know that anyone involved in the government's a friggin' idiot. So let's see. Losses accelerated into the week's close on comments by St. Louis Fed President James Bullard that the first rate hike could be as soon as 2022. The bond yield curve flattened out as short-term rates rose slightly and long-term rates declined. Let's go over here to the yield chart. It may be hard to see on your screen, but the darker red line is today, and then this slightly redder line is from May 12th. So you can see over the course of a little less than a month, for example, here on the 20-year, dropped from about 2.32 to wherever it's at today. Same thing with the 30-year, and then same with the 10. And then you can see on the short end of the curve, it's the darker line is slightly higher than the less red line. So anyways, but like I said, what that tells me is that people are buying more of longer term bond instruments because it's pushing, the yield is going down, so that means people are selling off. The longer term ones are not as attractive, and the yield is, am I doing that backwards? Let's see. The yield went down. So yes, had it turned around. The yield went down. So that means that the prices of the bonds went up. So and then the inverse on the short term. So sorry if I've mixed everyone up on that. So I confused myself a little bit. So let's see. The Fed surprise. Last week's FOMC meeting announcement took investors by surprise. There indicated that there would be 2 rate hikes by 2023. It was as recent as March that the Fed had signaled that rates would remain unchanged until 2024. So what happened in the last 2 months? Inflation from food prices, lumber, oil and gas, everything is getting much more expensive, and the Fed's having to get off their butts and do something about it. The Fed also raised its inflation expectation to 3.4%, up from its March projection of 2.4%. So I guess inflation is a little more transitory than they thought. All right, some economic news economic data coming out this week. Tomorrow we have existing home sales. Wednesday would be PMI, Purchase Managers Index. And then new home sales. Thursday's GDP, durable goods and jobless claims, and Friday is consumer sentiment. A few companies reporting earnings this week: KB Homes, FedEx, and CarMax. All right, so that's about that. So let's go over to some of the white papers I'm putting out. The first one is inflation and the real rate of return. So it just kind of gives an explanation of what that really means. The real rate of return is an important personal financial concept to understand. It is the rate of return on your investments after inflation. The real rate of return indicates whether you are gaining or losing purchasing power with your money. So with inflation checking in at a 5% annual rate, does that mean investments with less than a 5% rate of return is losing purchasing power? And it says that's where it gets complicated. So it goes through, a little bit of an explanation there. So, I mean, basically, if say your investments are giving you nice round number 10% return on your investment, and inflation is say 2, your real rate of return would be 8. That's really what that means. So, yeah, I mean, if your investments are averaging, say you're a fixed income investor with a lot of bonds and CDs and things like that. Maybe you have some older ones which have higher coupons. Let's say you're getting an average of 6.5% and inflation's running 5%. Yeah, you're only really making about 1.5% on your money. So, and then you have to factor taxes into that too. So, after taxes and inflation, you might not be making any money. So. All right, FAFSA Simplification Act. Parents and grandparents first. So the changes that were made were passed at the end of 2020. These changes affect those applying for financial aid for the 2023-2024 school year. And these changes, you'll notice these changes on October 1st, 2022, when the FAFSA opens up for that next school year. 529 plans from grandparents are no longer counted as cash against financial aid. I guess that's good news. Parent-owned financial 529 plans are automatically factored into the FAFSA when a dependent files and are only evaluated for up to 5.64% of available college use. A 529 college savings plan that allows individuals to save for college on a tax-advantaged basis. Yeah, just explain what it is. Simplified questionnaire has been reduced from 108 demographic, education, and identification questions down to a maximum of 36. So, they cut it down to about a third of what it was. Part of the restructuring was aimed to clear up confusion as to who is and who is not a dependent student and what type of assets should be included. Then there's also a student aid indicator calculation changes. Part of this questionnaire changes were due to changes made to the calculations for financial aid. The SAI is the math behind the scenes that determines what type of funding and how much student is eligible for. So it looks like there's been some regulatory changes for FAFSA and trying to streamline the process. Me personally, I wouldn't send your kids to college. It's a gigantic waste of money. I know that a lot of people were put off by the Libertarian Party of New Hampshire talking about legalize child labor. I think kids honestly would get far more out of internships and apprenticeships, learning how to learn some real job skills. That would probably be far more important than sitting on their butts and listening to some guy who couldn't make it in the real world teach them about BS. So, as you can tell, I don't have a high opinion of educators. So, all right, summer travel is back. Travel agents are working 14-hour days to meet the needs of eager travelers. Airports are reporting 80% of pre-COVID capacity. TSA screenings reached 2 million for the first time since the pandemic. So I guess if you're headed out on the road, you might have a little trouble maybe booking an airline ticket. I saw an article earlier that one of the airlines was reducing their flights over the summer because of too many travelers. I'm not sure why that's the case. But you might have a little trouble booking hotels and stuff in some of the big travel destinations because there's a lot of pent-up demand there. So, all right, and the last white paper, this was hot off the press today. The Fed acknowledges inflation. Shocking. The Fed, we just talked about this, that the Fed raised its inflation projection from 3.4 up from its March projection of 2.4, effectively raising its inflation expectation by 42%. I'm glad someone knows how to do math. The Fed's course correction on inflation expectations and planned interest rate hikes unsettled the markets. We already talked about that. And yeah, so, alrighty. Well, let's go ahead and kind of finish up on a couple of articles or white papers that I wanted to share with you guys. This is from First Trust. This is just their weekly commentary. I wanted to read a little bit of this. The Federal Reserve was once again in focus last week as they held rates at zero as expected. Interestingly, the dot plot showed officials expected 2 rate increases by 2023. The Fed increased its expectations for inflation, and 13 of the 18 officials favored at least 1 rate increase by the end of 2023, and 11 of 18 forecasted two rate hikes. However, regarding asset purchases, the Fed noted that they continue to expect asset purchases to be held at $120 billion until substantial further progress had been achieved with regard to inflation and employment. So it looks like they're going to start raising rates, but they're not giving any indication to slowing their bond purchases, which is just continuing to bloat the balance sheet of the Federal Reserve. I really wouldn't, not that I really think that this is savable at this point. I think the Federal Reserve is going to collapse. I wouldn't be surprised if the federal government were to fall apart and we split up into separate states, which, in my world, that's ideal. I know I'd have probably 30 or 40% more money in my pocket, and then even, the average person would probably have anywhere from 20 to 25% more money in their pocket that they're not donating to the Treasury. So, if this was to be fixable, we would need to see, the Federal Reserve increasing interest rates and let the market determine those rates. Stop the bond purchases and start liquidating those positions, regardless of how painful it might be. But to continue to just overeat at the buffet and expect that you're not going to die of a heart attack or diabetes or whatever, it's insane. I've in the past shared, if you took all the zeros off of like the federal government's spending and income, if it was a family with those numbers, you'd look at them like they were nuts. So, all right, and let's see here. This little bit, the S&P index turned its worst week since February, declining 1.48. The index had a positive day on Monday, hitting an all-time high, but it reversed course. So yeah, we did hit some records last week on some indexes, which, over time those records break. I really don't consider that a big deal. So. But it definitely was a volatile week in the market. All right, and then this last thing from First Trust I wanted to share is the fake tight labor market, and this is from Brian Westbury. And I'm just going to read a couple passages here. Starting out, is the United States job market really tight? Well, that totally depends on your perspective. From a national perspective, it certainly isn't tight. Total non-farm payrolls were 144.9 million in May 2021, still down 7.6 million from February of 2022, February of 2020, right before the COVID slowdowns. In addition, when asked, 9.3 million American workers say they are still looking for a job, up from 3.6 million during the same time frame. So people are looking for work, but the labor market is tight because unemployed people are getting more in benefits than they would actually getting off their asses and being productive. So at some point, the free ride ends, and either because we as taxpayers just refuse to pay taxes anymore and those people starve, or they get up off their butts and do something productive with their time and quit being a parasite. So What was the next thing? The labor force participation rate, which is a share of those 16 and older who are either working or looking for work, was only 61.6% in May. Pre-COVID, you'd have to go back to 1977 to find a level that low. So again, pre-COVID, we were at 63.3% of people participating in the labor force. So, I'm not hiring people, so I'm a one-man shop. I really don't need anyone else to do what I do. But if I had a restaurant or a small business, and I had people demanding $15 or $20 an hour to do basic tasks, I'd say sorry, that's just not going to work out. So we'll see where this goes. But at some point the government has to stop incentivizing people to be lazy. So, and then this last article I wanted to share, I saw this, might have just been on my Google homepage. Rick Ross, he's a rapper. I really don't know the guy that well. Rick Ross shares that he saved money by cutting his own grass and flying commercial. So in this article, it talks about how Rick Ross, he purchased a 235-acre estate in Fayetteville, Georgia. It had originally been owned by Evander Holyfield. And so 235 acres, pretty large spread. And, he'd been told that Holyfield had spent $1 million a year, maintaining the grass. So I guess him being a frugal guy decided, hey, I'm going to save $1 million a year. So he went out and bought a John Deere tractor, and, he cuts it himself. So, in the end, he saves $1 million. Yeah, he's got to go out and spend a few hours cutting the grass, but, hey, I change my own oil. I'm the kind of person who does my own yard work, and maybe that's why I have, a pot to piss in. Most people try to outsource everything, and, things you can do yourself, you can save a few bucks, and those bucks add up over time. So, again, this is more of a food for thought article that I figured I'd share with you guys. So, what's he say here? Taking care of his own grass isn't the only way that Ross cuts corners. He tells Forbes that he has an affinity for finding beautiful things that cost $8 or $20 at swap meets and antique stores. He takes commercial flights on Delta as much as possible, and he forges partnerships with companies that align with his lifestyle. So being wealthy doesn't mean being stupid. So you got to have a nice, save your dollars, or save your assets, put them into things that will hold their value over time, and you'll be all right. So that's everything I had for today. Let me go ahead and if anyone has any questions, concerns, feel free to reach out to me via email or phone call. And otherwise, I will be back on Friday with the weekly wrap up. And if there's any exciting news between now and then, I might jump online and have another video. So also the 5498s from TD Ameritrade are going out this week, or definitely by the end of the month. So anyone who had contributions to Roth IRAs, traditional IRAs, that tax form will be in your mailbox probably within the next 2 weeks. So I'd gotten an email from Ameritrade late last week with that, and I forgot to mention it on my Friday video. So anyone who's still hanging around 18 minutes in, there's that info. So hope you have a good week, and I'll talk to you on Friday. Bye-bye.